Next panel on the trends in calibration and investment. And here is the moderator of the panel, Mr. Sujoy Bose. Welcome.
Thank you. And I'd like to welcome the rest of the members of the panel. I see that Mr. Maurizio Tamaggini, the CEO of Fondo Strategico Italiano, he's right at the end, followed by Konstantin Ryzhkov, who's the Deputy CEO of the Russia Direct Investment Fund. Then we have Kyle Mangini, the Global Head of Infrastructure for IFM Investors, and Wim Hazelegger. Wim, I hope I pronounced that right, who is the CEO of APG Asset Management in Asia. First of all, thanks to Shakmar and Israfil for the invitation to beautiful Baku, and they even fixed the weather for us, so it's just fantastic to be here. Thanks also to the teams, the SOFAS and KIC teams for all the support on the preparation for the panel and for the logistics. So some of you, I've been talking to some of you, but as of mid-October, I'm actually heading from IFC to India to start up the National Investment and Infrastructure Fund, which I would like to think of as a kind of a sovereign-led co-investment platform for infrastructure in India. And so clearly, I am the most curious member probably of this group, and I'm probably also the most keen consumer of this panel, because this panel has tremendous experience in co-investing. And as we have heard earlier this morning, the trend in asset management is clearly more towards direct investing and co-investing. So, and the co-investing structures have also evolved from basically co-investments with external asset managers to more co-investing as a group into assets, or in some cases forming actually partnerships to more strategically look for co-investments rather than compete for investments that come up. So, and this was very, very nicely explained this morning in one of the panels in terms of why it's going that way. But I think to set the context, the panel members over here, each one of them are with an institution that has actually had very interesting experiences on co-investing models. So just to set the context, gentlemen, if you could very quickly just introduce your institutions and also talk a little bit about sort of the co-investment approaches that you guys have worked with in your institutions. Why don't we start with you, Wim?
Sure, thank you, Sujoy. But yeah, I represent APG Asset Management. APG is a Dutch pension fund asset manager. We manage roughly about $500 billion US dollars across the asset classes, which we've grouped into well, essentially 12 different buckets. And we do that across 3 regional offices, being headquarters in Amsterdam. We have a New York office that covers North and South America, and we have the Hong Kong office that covers the entire Asia-Pacific region.
Thanks.
Thanks. I represent IFM Investors. We are an Australian-based manager, but we have a global focus and a global infrastructure fund. IFM Investors is owned by 29 Australian pension funds. So we're owned by not-for-profit funds, and we were really established to be the outsourced manager for those funds. Today we work for many other institutions, but our primary clients over a long period of time have been those institutions who effectively own us. We started investing in infrastructure a little over 20 years ago, and we started by going into other people's funds. Over time, we built out our capability. We started doing other people's co-investments. We then built out our own fund, and we now are in a position where we offer our LPs co-investment opportunities. So we've really gone through the full spectrum from being a fund investor, a co-investor, and now offering co-investment opportunities. So we've seen a whole range of variables in terms of how this comes into play. Currently, we've got the largest portfolio on the planet. We've got about $25 billion of direct infrastructure investment in 9 countries. And I think what's important in terms of the model is we sit next to 35 other institutions across our portfolio. That's everyone from the Canadians to ADIA and strategics like Elia and Shell.
Konstantin Ryzhkov, Russian Direct Investment Fund. For those of you who are still curious what we are, it's a $10 billion sovereign wealth fund of Russia, investing with the primary goal of investing directly in private equity opportunities in Russia, with some allocation going kind of outside of Russia, but primarily with some of the Russian angle involved. We are also managing in some form and shape another 15+ billion of partnership commitments coming from primarily different sovereign wealth funds globally, again, investing in Russia. I think, there's it's a very important kind of structure that was about 5 years ago implemented by the government, is that it's a co-investment fund. The reason RDIF was created is to stimulate private equity and strategic investments by international companies and international investments in Russia. And, RDIF is serving as a sort of a skilled professional local partner, giving some both sort of a political support as well as support on sort of a hands-on, kind of on-the-ground level sort of work. In terms of some of the achievements, and we're turning 5 years now this year, we have invested close to $8 billion in Russia over this course of 5 years, for us and our partners. In fact, about $2 billion came from, close to $2 billion came from RDIF's main $10 billion fund. The rest of it came from either won by, deal-by-deal partners or our co-investment partnerships. I think, this year is also important because it's first time we've actually done a number of investments outside of Russia. And, probably later on, I'm happy to talk about some examples. But again, we are, very much focused on returns, because the only way we can attract partners into Russia is not by saying that this is a great development angle or this is a great political investment. No, it's you will come and invest with us in Russia only if your risk-return profile will kind of match your expectations, right? And hence our biggest focus is returns. And again, happy to talk about more of the elements of the fund, how it works, how it operates, because I think this is an interesting story to be told and to be heard. Thank you.
The story of Fondo Strategico Italiano in terms of size and structure and business model is actually quite similar to the one of our partners and colleagues from RDIF. The feature and the reason why Fondo Strategico Italiano was created is different at the onset. All of you are familiar with the fact that Italy actually has a large public debt. So how does a public debt coexist with a sovereign wealth fund? The reason is that next to a public debt, for the one of you that are familiar with the country, there is one of the largest private savings, family savings surplus. So actually from one side, those savings can be put together, and there is actually a bank, a development bank, that has gathered most of those savings. The government, therefore, has promoted that some of those savings, which are quite substantial, more than $1 trillion, are directed toward what we have in Italy, which are a series of mid-caps, which are excellent companies in terms of technology, products, and markets that they want to direct to, but they're not very large in size, and therefore they could have a bridge in terms of growth equity in developing into the global markets. It's actually a little bit of a market failure, because next to those 1,000 and change market leader in their niche, most of those companies are actually not penetrated neither by private equity nor public equity. So it is a huge unexploited opportunity for people such as yourself and ourselves. We have started to invest, and as we invested, we found out basically 3 features. The first one is that the formula to invest next to the shareholders of the companies, most of the time next to the families, does work. It is possible to invest also in terms of growth equity and therefore not just a typical leverage buyout. And doing that brings very good returns, which is what, as Konstantin has said, eventually we care because we are benchmarked against the market and our priority is to make returns. In doing that, we experienced that a lot of foreign investors wanted to invest with us. And at that point, had a gate to go, had an institution to partner with, and they felt they had confidence, comfort, and trust in this institution. So what we did, we started to promote some co-investment agreements. Now, co-investment agreements, as you start, a little bit like a heart. Each partner desires to have an investment agreement. It's like a suit on his own fit. So just to give you an idea, with Kuwait, we invested on a 1 to 4, 2.5 billion, so 500 million were coming from Kuwait, on a GP to LP type of structure in which we were the GP with the Kuwait Investment Authority. With Qatar, different, we did a 50-50 JV sectorial on the so-called made in Italy sectors, 4 sectors. With other partners, which we have established relationship, for instance, with like Korea, who is here with us, or RDIF, who is sitting with us, we have established voluntary co-investment agreements. With the central bank, we have made them invest up on the top company because they were interested in all of the portfolio. Soon enough, we figured out that managing all those co-investment agreements was fun, was profitable, was bringing returns, but at the same time as a limit in complexity. But on this one, I may come back later. Very importantly, though, finishing up, is that in doing those investments and in bringing returns, we also have solved what was the objective so far of the establishment of the Sovereign Wealth Fund, i.e., hopefully creating some economic development as a side effect of doing good returns. And in fact, the company that we've invested in terms of direct and indirect labor production, and in terms of EBITDA growth, are yielding and benchmarking very well compared to market averages. But that needs to be an effect of doing very good business, making good investments, and making good returns for the shareholders and the investors that have provided us the money, either directly or through the co-investment agreements, and not the main reason, which is one of the major topics that in the Sovereign Wealth Fund community today is largely debated, as you all know. Thank you. I will come back on the point of complexity of co-investment agreements later.
Thank you all. You know, as I was learning about their institutions and their history in co-investment approaches, I was amazed as to how much experience there already is in this field, and it's fantastic that, you know, institutions like, or organizations like CROSAP is actually trying to bring all this together. So it's really quite phenomenal. But just again to bring us back to the context a little bit, Kyle, you've been managing infrastructure funds for 20 years. So what's actually the benefit of a fund, and then why should investors actually get into direct investing and co-investing?
Well, I think as a starting point, it's important to recognize that this is private equity, right? It's private equity in a specific asset class, but it's private equity. And the ability to invest in a space is a function of capability. So I think the benefits of a fund are really the benefits of the manager in particular. You're buying the manager's skill, you're buying the ability to find good deals, you're buying the ability to avoid lousy deals, And very importantly, you're buying an ability to manage the assets. This is not a set and forget asset class. It's an asset class that requires active management. You know, we used to say that you chase dollars. Now we say you chase cents. And you've really got to ensure that when you're looking at a particular situation, you've got that right skill set. So I think the benefit of a fund really is a function of the benefit of the manager, exactly the same as you would look at it in the private equity space. I think one of the other benefits of a fund, depending on the way the fund is structured, is the diversity and the portfolio composition. We're an open-ended fund. We're a large open-ended fund, and that means that for a newer investor, there's an ability to immediately be diversified across the asset class, and you're clearly not going to get the same diversification benefits from doing a co-investment. So I think there are clear benefits of being in a fund. And equally, there's benefits of the co-investment approach. I think what we hear a lot about in terms of different parties talking about their co-investment strategy is they want more control over asset selection. They want to be able to target assets they like. Sometimes they want to be able to avoid assets or geographies that they don't like, so they have much more control over that part of the thought process, and that does make a lot of sense. And sort of how that then translates into the broader components of their overall portfolio strategy. So look, I think to me, it probably makes sense to have a combined strategy. I think there are benefits to both. I think that a fund provides you with the opportunity to get educated on the asset class, to get smart about it, to get up the curve. And then co-investments as a next step provides you with a further ability to get much closer to the asset class and a much greater level of insight. But really, it's a function of where institutionally parties are in their evolution. You can't do it halfway. If you look at the Canadians, they have built out very, very good teams. They pay their people extremely well. They're formidable, they're smart, and they can execute. There's other parties who have tried to do it with a handful of people sitting in an office in a big city, and all they're going to see are relatively picked over deals that other people have passed on, and you really can't have a halfway approach, particularly if you want to do it on a global basis.
Thanks, Kyle. And Konstantin, you're on the other end of the spectrum, which is you have a unique investment model in the sense you only co-invest. You can only co-invest. So what are the advantages and challenges of having that only co-invest approach?
Well, I mean, I think you have to look back at, again, why we were created. I think, the reason was that the private equity universe of private equity firms investing in Russia was not good enough or sizable enough compared to the country of 140 million and the kind of relatively large economy that can afford more players in the market, right? And that was, really a request from the global investors that a fund such as RDIF, is created, right? To help them get greater comfort, both in terms of political support, as well as in terms of someone on the ground who knows market and the country better than any global institution, who hasn't spent resources, time studying the market and learning about it, right? I mean, they don't have the expertise. One of the requirements, like when, again, I think, it's a great credit that has to be given to the government that they actually listened and heard advices of, global private equity managers who, suggested the structure of RDIF. So, one of the advices was that, you should not have such fund take more than 50% of any investment. Because what they were fearing and what they wanted to avoid is government indirectly controlling the assets they put money in, right? So what we have is by mandate, by default, we are a minority investor who brings the local expertise and knowledge to the partnership, to get, and help making those investments better. In fact, it's interesting, but what we see is that, some of the both private equity investors, some of the industrial investors, when they come to Russia, they tend to be willing to pay a higher price for the asset than we do. And it's actually, thanks to our involvement, some of them avoided huge mistakes. And thanks to our involvement, others who did invest, at a better terms, just because the expertise that we provide and the local knowledge is something that people don't have, right? And, I think, if you think about this, the purpose of the fund is to eventually lose the purpose of it, right? Because the more people invest in the country, the more people build up their internal expertise, the less need they will need in a partner like RDIF, right? But I think we still have a long way to go, and our job security is there. What is important, I think, is the partnerships that we have created that allow financial investors to have a choice on how they want to get an exposure to Russia, right? And because of that, if you open up our website, you will see that almost, if not every country, but every major source of capital in terms of the sovereign wealth is one way or another part of our partnership sort of a model. I'll give you an example. We have a partnership with CIC. That partnership was formed in the way of a joint venture fund, right, with an equal contribution, and that fund has its own mandate, right? And you will, hear later one of my colleagues from Russia-China Investment Fund talking about this, right? The other funds, for example, one of the first supporter of RDIF, and actually it was almost like tailor-made structure for them, was Kuwait. Kuwait Investment Authority said, listen, I want to have an exposure to Russia, but I don't really want to build up the team, start creating internal expertise in Russia. I like what you guys have. I like your expertise, the talent that you have managing your assets and money, so I'll just give you capital to manage. And that's how another structure was born, which we called automatic co-investment, which effectively similar to LPGP structure, where people co-invest with every dollar that RDIF puts in it. And there is a third structure, with a number of other kind of major sovereign wealth funds, where they said, we actually want to get, internal knowledge, and we want to build up our internal expertise in the country. We want to learn, co-investing with RDIF. Hence, they made the sort of sometimes very large commitments to Russia and to RDIF, but they actually make their own decision every time they make an investment, right? So they actually have the team looking jointly with us at every opportunity. They take it to their investment committees, and they, every deal effectively taps into that larger commitment to Russia. So again, managing that is a challenge because you have a lot of partners, you have a lot of opportunities, but I think what we've figured out how to do is that, not only there is always an opportunity for, for every one of our partners to participate in every deal, but there's also, a learning curve that we went through that we realized that some assets are better fit for some partners, while others, for other type of partners, right? So, and that has been working well so far. I think, that's, partly a success that we're not really trying to stick, every deal to every single person. We actually know what their investment criteria, what their expectations on, every dollar investment in Russia, what their asset class preferences, and I think it worked very well. And the fact that it's working well, is demonstrated by, kind of greater capital being allocated to RDIF in Russia.
Very, very interesting, and similar to what Mauricio also said about the customized approaches, with different partners. But Mauricio, before I come to you, let me just ask Wim. APG has been involved in a number of these partnerships as well, both on the infrastructure side in Asia. Please describe some of those for us and tell us what the experiences have been.
Yeah, I'll do that. Before I go into the actual examples, let me just build on something that Kyle said, because we are an asset manager that actually made the transition from being a, call it passive, commingled fund investor to a direct investor. And what prompted that? We've been investing in infrastructure for since 2004 and have quite a substantial portfolio. And we were always a traditional commingled fund investor, essentially for the same reasons as Kyle just said. But during the global financial crisis, or based on the experience that we had during the global financial crisis, we actually found out that we could commit a substantial amount of capital to a fund, but effectively had nothing to say. Yeah, so we started thinking about other ways of deploying that capital, and started direct investments in roughly about 2009 and 2010. So that reason was probably the primary driver. Obviously, what we've seen over the last couple of years kind of strengthens that proposition. Obviously, is that there's a lot of capital flowing into certain asset classes. Predominantly, let's say infrastructure and real estate. Yeah, so there's a incredible competition for a very limited number of assets that are available. So we actually think that the direct investment model for us is key to executing our investment strategy. So we place a lot of time and effort in creating platforms across the region with the best-in-class local partners. And the reason being that by creating a platform, obviously with the aim of scaling that up over time, gives us much more kind of security about future deployment of capital. Essentially what we're doing, we're eliminating some of the competition that you see when certain assets are coming to market. You have very competitive bidding processes in Australia and the like. And by proactively creating these platforms, being able to scale them up over time, is, for us, as being a large, asset owner, gives us that security to the future. I think a second reason is very much, and Kyle mentioned that already, that model gives us, much tighter control over the assets that we own. We put in place a very kind of robust governance structure. We take board seats as well, become very active in effectively overseeing and managing the assets. So that we're much closer on the assets than we would be in a traditional commingled fund. Another reason is that, and Carl didn't mention that, but for us, the direct investment approach is cheaper than just going in through a commingled fund. So having said that, that's what we've been doing over, let's say, the last 6-7 years across the region, and a couple of examples just to mention that is a platform that we created on the infrastructure side in India. Was the second half of last year with Piramal Enterprises, which is a very large Indian kind of diversified conglomerate. And effectively what we did was create a joint venture where each of the partners committed $375 million US to provide structured financing solutions for local infrastructure companies. Structured financing options effectively is that we provide mezzanine loans to these infrastructure companies, effectively to capitalize on the mismatch there is in India. Currently there is between your demand and supply of capital. That works very well. Like I said, there's a great alignment between the two partners in terms of capital commitment, and that works very well. Another one that is interesting maybe to mention is Yisheng Redwood in China that we invested with now maybe 2 years ago. And effectively what Yisheng Redwood does is they're one of the largest Chinese developers and operators of high-grade logistics facilities. So we set up a joint venture with them that is owned 70-30%. to develop these logistics facilities. But maybe more interesting, some of the things that we bring to the table as well in those partnerships is that we can assist those partners in diversifying into different sectors or even geography. So what we did with Yisheng, for instance, you're kind of leveraging on our reputation within the market, is try and bring in other partners as well to kind of grow the platform and raise future capital. So with Yisheng, after we set up the initial joint venture in China, we expanded Yisheng into Korea, set up a joint venture with Yisheng and one of our Canadian peers to develop high-grade logistics facilities in Korea, and subsequently we merged Yisheng with Redwood, creating the first pure-play Asian logistics developer, owner, operator there is. And maybe the third one, interesting to mention as well, that kind of builds on the previous example, is that we took we partnered with a best-in-class student housing developer in the UK, took them to essentially partner up in Australia. And what we're doing with them in Australia is build, develop a high-grade student housing. And again, capitalizing on a huge mismatch between supply and demand. Education, as most of you will know, in Australia, I think it's the third biggest export product, and it was a huge mismatch. So we started investing with them in the beginning of last year. That's ramping up really fast, and essentially what we did then is brought in new partners to raise further capital and grow the platform. So we brought in ICBC at first that committed capital to it. And in the second raise, we brought in Bouwinvest, which is another large Dutch investor, to bring in additional capital. And now it's a platform that almost has like almost $1 billion Australian dollars ready to deploy.
That's quite a sort of continuous story of platform investing. And I may also say that which is also has a very strong kind of a development impact for the countries and the regions where you're building them, because they are able to operate at scale and they're able to attract talent into them. So great stories over there. Mauricio, you mentioned a number of co-investment partnerships. Which were some of the most successful ones? What were the success factors, the key success factors, and how did they benefit the partners who were involved in those co-investment arrangements?
Well, I will not go through each of them because they're clearly all different, and in their own way, the financial metrics have been touching wood very good, so they are all achieving very well the objectives of the specific partners. Probably is more interesting, again, restating what are the assumptions. You have a country that has 0.1% of GDP in private equity, and the average in Europe is 3 times as much, 0.3. In France, is actually 0.4. So you have an under-penetration of private equity. You have a country in which public equity is represented in terms of corporate at 15% of GDP. In the UK, it's 125%. In France, it's 50%. So you have a market failure with, at the same time, a group of companies in the second largest industrial economy in Europe that are basically unexploited. If you look at the top in terms of market share companies globally, Italy ranks fourth after Germany, the US, and Japan in terms of market leadership in specific niches. So there is the product, and you just need to link the product of the company into the investment. What are the advantages of doing that? I'm going to list very quickly because time is going by. 4 for us as collectors of money, if you wish, and 4 for the investors. For us, clearly, there is more firepower in terms of investing. 2, there is certification of our investment that has been done by other excellent co-investors. 4 eyes are much better than 2 eyes, we say, in the investment community. 3, there is a credibility factor of those companies that are being invested by those investors that are globally present around the world. Fourth, clearly, we are feeding the demand that is there otherwise unexploited and is naturally brought to us. For the investor, first and foremost, the investor gets most of the time a better execution in terms of, Konstantin was saying, valuation, how do you select a company, the due diligence you do, the monitoring of the asset as you are there because you're not locally present most of the time as a co-investor, transparency and governance. All that is extremely, extremely important. Second point, the investor with us, in terms of our statistic, most of the time, 9 out of 10 of our investments are either proprietary or quasi-proprietary. So it gets through a pipeline that otherwise would be very difficult for them to have access. And that is, again, because of our institutional nature. So proprietary pipeline that otherwise is not available, also because if you're not a local, you don't spend time in the country. Third, and as important, you are investing with somebody who doesn't have a conflict of interest, is putting money next to you. He's not advising you, he's not brokering, with the greatest respect, all the advisors that are much needed, is putting money where the mouth is, as we say, is putting skin into it. Fourth, and as important, and the colleague from APG has mentioned, most of the time in this kind of situation, you end up spending less because of the 3 points I've made, and because you're saving fees and you're saving having a local presence that most of the time is extremely, extremely expensive. So 4 important advantages: better deal at the end, less cost, proprietary pipeline, and the fact that somebody is putting his skin in the game in a symmetrical way to what you're doing.
And when you're working with these co-investment arrangements, how has it pushed FSI itself to evolve and transform as you manage these partnerships?
Sorry, I lost the first part.
So as you're managing these co-investment partnerships, what has that meant for FSI itself in terms of how you have evolved and transformed yourself to work under these arrangements?
For us, this has been an extremely fascinating learning experience, first of all, because you're dealing with, dealing with our friends from SOFAS or from RDIF, you really meet different investment cultures, different investment objectives, and you try to meet and tailor-make them. So it's a great learning experience. At the same time, in our case, that has brought into and this is a difference between us and RDIF, into the need to structure phase 2. Everybody now call it 4.0. We are at 2.0, which is the fact that in a country such as Italy, co-investment agreements, they hit a wall at a certain point if you do too many because of the complexity that is generated into it. There is an issue of fairness. If you have quite a bit of deal flow, how do you pick, with the greatest respect, investor A versus investor B versus investor C? So we ended up at this point launching, and we're about to basically be, by the end of the year, we're going to be ready to go. We have, because of the demand was quite substantial, we have created what we call it the Italian Excellent Company Growth Fund, where we basically go and use part of the money of the Sovereign Wealth Fund to generate an LP-GP structure where most of our Sovereign Wealth Fund, actually all of them that have invested with us, converted their commitments. Others have been invited to join. And clearly for any of you guys that are interested in chipping in, we'll be more than happy to show you the papers. But basically we're going, after phase 1, which was a starting phase, we're going into, for part of it, because the government still maintains for most of its debt, strategic asset of national interest, whatever it is, its own function and sovereign wealth fund type. But for the market investment, we've carved out this LP-GP structure, which is much more familiar and easy to manage also in terms, as I said, of fairness of how you make people invest and co-invest in an equal and not asymmetrical basis.
Thank you, Marcio. Kyle, I'm going to ask you this question about co-investors. What do you look for in a co-investor when you're putting together one of these partnerships?
Well, I think as a starting point, the first and most important variable is finding a competitive edge, right? I mean, we are in a market where there is a substantial amount of capital, and we need to do everything that we can to be more competitive than the other players. So we'll look for a local level of insight. We might bring in a strategic operator, but anything from a consortium perspective that can give us that edge in both owning the asset and managing the asset over the longer term. In terms of working with financial investors, there are some really important variables around the ability to make decisions, the ability to work in real time, and the ability to understand the assets more broadly. So a skill set that ensures that if we're working together through a process, we're going to meet the timelines because the clock doesn't stop, and the investment committees better be able to meet at midnight on Saturday because that's the way life is. Or in a situation where we're selling down, the ability to get across a range of issues. And I think there's a lot of aspects to the market that we learned the hard way over a long period of time. And I think I'd echo the sentiment about having skin in the game on the other side of the equation. One of the things that we're seeing in the market now is the emergence of institutions hiring managers to bring them deals. And so the term is mandate money, effectively. And the problem with mandate money, the problem I have with going head-to-head with mandate money is there's a complete lack of alignment. The managers simply want to get the deal done, and they're putting forward business plans and financial models that are incredibly optimistic. And that creates a real distortion because there's a lack of skin in the game in that regard. And then one of the other things that we learned over a very long period of time is in situations where there is an organization that buys an asset and sells the asset down, what they do with that asset in that interim period is critically important to be able to see and to be able to understand. And we identified situations where parties bought assets, put in place off-market swaps, put in place off-market debt facilities, paid themselves $50, $75, $100 million, and never disclosed that to the co-investors. So, having an ability to see through that and understand that is critically important. So, in that sense, it's a function of trust. We want to work with people who we trust, who trust us, and who share our priority around ESG and owning and managing the assets in a way that benefits us together in terms of returns, but also the community more broadly.
Great insights, thank you. Look, I can go on because I'm very curious to pick their brains, but at this point of time, maybe we just open it up and see if there are any questions on the floor. So, open for questions. There's one at the back there, if you can get a mic there.
Thank you. Do you hear me? Because my previous question wasn't heard very well. Do you hear me all right?
Not very well. If you could just hold the mic a little closer.
Okay. Do you hear me now?
Much better.
Okay,
Yep.
thank you. Karina Luchinkina from PwC. Mauricio brought up a point of fairness in the relationships with co-investment partners. I wanted to ask Konstantin to comment on that and how do RDIF achieve that? Because obviously you have quite a wide range of partners with who you're working in Russian market.
Sure. I think fairness with our partners, first of all, again, as we're saying, is that every partnership that we have almost like a commitment or an arrangement where we offer any opportunity to all of our partners. They have a right, depending on the structure, depending on the type of partnership, they have a right to opt out, of some sort, right? But every opportunity is offered to every partner that we have. What it brings, it's a twofold story. On one hand, I think everyone feels that it's, they get to see the whole pipeline that we're doing. They get to see all the opportunities, and they can pick and choose where they would like to put kind of more capital and focus more on. At the same time, there are situations where, deals become oversubscribed, and at that case, we effectively have to, scale down everyone's participation, but that scaling down happens in the pre-agreed proportions, right? So everyone has a chance to participate in the pre-agreed proportion. If there is some of the deal size which allows for larger, take from some of the partners or from our side, we're still open to that. But again, it's at the end, it's a deal-by-deal story, where people do have an opportunity to participate. Some of them participate on a discretionary basis, but we want everyone to have exposure, right? Even if it becomes at some point a very small one, we still believe that this is just another seed into people's better understanding of the country, on people's better understanding of specific industries, and their ability to see what type of return they can make eventually in those industries.
I actually have a follow-up on that, and it's for Konstantin, for you and Mauricio. As sort of co-investment leads that are led by the local governments, by the national governments in both your cases, there's clearly the balance of development and financial returns. How do you balance this? And I know, Konstantin, you said that it has to be, at the end of the day, financial returns are the key. But do you see any issues with balancing the development and the financial returns?
I think, first of all, again, going back to the purpose of the fund, right? The purpose of the fund to bring global capital, long-term smart capital into the country. You cannot force people to come in whatever politically great story it is, right? I mean, people will come only if they see, attractive returns, right? And we're dealing with very smart investors, right? I mean, you cannot trick them into this, right? So that makes the return profile of any investment we do being the top of priority. At the same time, we do, and we typically are very mindful at the fact, of how every investment will be perceived by the government or the public, right? I mean, let's put it this way. If there is an opportunity to put, primary capital in investment in specific industry versus cashing out, call it, already wealthy oligarch, right? If those, competing opportunities will have a similar, return profile, we will most likely choose the first one, right? But again, we're still not limited to do the second one as well, right? We're also looking at every aspect of bringing value, in every investment. I'll just give you a very quick example. The deal that we just recently led with CDC Capital, right, with our French partner, is an investment in ARC International, which effectively the global leader of making glassware, right? The logic in that deal was not only to support the company in its growth ambitions, but also it was one of our first, second, investments outside of Russia. The logic was that, the company is actually, out of the total size invested in the company, significant amount of capital is coming back to Russia to modernize the existing facility and to build a brand new facility, which will be probably one of the best and most efficient in the world, right? So that is the development angle that we're bringing into. It's extremely attractive because of the kind of the free economic zones benefits, kind of no taxes, infrastructure, and support given by the government. That and kind of given or coupled with, relatively cheap labor cost, energy cost, which makes it extremely attractive from economic benefit, basis for the company. It also allows us to demonstrate what a great benefit we're bringing to the country, right? Because it's a job creation, it's a transfer of technology, and et cetera, et cetera, et cetera. So there's always any investment that you do, I mean, it has a need for the capital, right? And typically that need for the capital, pushes, advancement of the company into either new production, into, expansion, into creating something. And that, obviously something that government and public loves. That's what they feel is an important sort of description of what the sovereign wealth fund should do. But I think, on the back of it, the most important criteria for us is returns. I think, another point that just to mention, why returns are also that important is that, I think we may be one of the first or very few sovereign wealth funds that initially the whole structure of the setup, has a very important element. We all have a carried interest in the deal. So we're no different from any sort of a private equity, general partner, right? That is one of the biggest motivating factors, right? I hope I know what I'm going to make out of any investment I'm making, right? If kind of all the expectations come through, right? And that I think is one of the critical elements for any sovereign wealth fund who is thinking about investing directly, because you have to attract the talent from the market and you have to compete with global private equity firms for that talent. And I mean, it's sometimes very challenging to do that if you don't have the similar instruments, to give to those managers.
Thank you. Please, Mauricio.
If I may add, in addition to, I think I can put common RDIF and Fondo Strategico here, that the whole governance has been built to really cater for returns and to be completely detached from government, including, as I say, the incentives, management incentives, but also risk policies, investment committees, so on and so forth, external bodies, completely independent decision, also with independent board members at the board level and investment committee level. That said, yesterday I was, just to give a practical example, I was visiting one of our co-investors who is going to become a significant limited partner in our new growth fund for the best of Made in Italy. And he was interested, as Konstantin said, in the returns. At the end, he said, by the way, can you send me some metrics on what all this means in terms of what the companies are doing, in terms of the so-called economic development? But that's exactly the same thing if you look into Blackstone website that Blackstone does. So in our case, it's returns. What we do in terms of making sure that we are consistent, we choose the perimeter, i.e. we invest in companies that are already fit. We don't do turnarounds, we don't do highly leverage. Actually, we do very little leverage because we are a growth fund. And we have a certain set of sectors where we go in. Once we have defined the returns with this formula of investment, we apply the formula, and that is going to come out the result. So the possibility that you have whatever form of interference is eliminated, at least in our case. Then, if you do a good job, and statistics not just for this kind of funds, but for the private equity in general, usually you show that good returns create growth, economic development, and therefore a better environment for the country, for the local communities in which everybody does invest with these kind of features.
And there's a lot of research now that's coming out to show exactly that there's a strong correlation between economic returns and financial returns. You know,
If I may add one thing, there is an interesting one for, as we are talking to a very sophisticated group of colleagues here, that this is a little bit of a selfish interest, that shows that growth equity performs better in terms of return than LBO equity type of investments. This is coming out actually from a couple of universities in the United States and is about to be published. And it's done out of a set of 20 years. But that's is a little bit of a selfish because that's the way we invest. Not necessarily, I'm sure that you could find others.
Thank you. So just to take, Charles Dallara's analogy, we were the panel from Mars, but I think, even without the Venus aspect of it, I think we did a fantastic job in terms of bringing out some of the insight. So ladies and gentlemen, a hand for the panelists and their excellent insights. Thank you.